if I'm an angel and I start investing alone in startups, looking for startups around in incubators, accelerators, in program, whatever, events, and I want to invest in them, I will have some challenges to overcome. So I need to find good startups to do the scouting, and it takes a lot of time to talk to hundreds, thousands of startups. Then I need to evaluate all those opportunities and decide alone on those opportunities. It is called screening. So to decide the ones I want to invest in, but then I need to build relations with in the ecosystem, in the incubators, accelerators, co-investors, other people to bring me deal flow, but also to co-invest with me and to help me to help those startups. I need to negotiate the deals. I need to go through the due diligence process, contracting, the legal stuff of contracting, deal terms, all that stuff, mentoring those invested startups, helping those startups to raise the next rounds, managing the portfolio when I have several startups, and then I need to manage the exits of those startups to have the final outcome. So when we look at this, we can tell that it is a lot if we are not dedicating to that activity full time, right? So how to be an angel, but not dedicating full time to that activity to do it right. With this in mind, we see some things that happened in the market. So we see those solo angels started investing in groups. So through syndication first, or through small companies investing, like five friends coming together to a company and investing together in some startups. So those solo angels started investing in groups. And it is better because you can share the experience of everybody. The decision-making process is better because you can discuss. So you're not deciding alone. Um, and you can learn from each other. So this is one trend, something that is happening in the angel industry. But also another thing is, why are angels investing in through two or three startups and then losing all the money and then being frustrated and not investing anymore? So this is happening a lot, and we call those angels the tourist angels. The tourist angels come, they invest in two or three startups, they get frustrated, and they go. Um, this happens because the angel industry is not applying the portfolio theory. What is the portfolio theory? Says that if we have, as a standard, one great startup out of 10, if you invest in two or three or four, the odds for you to invest and to lose all your money are high. So if you invest in a 20 startups, 30 startups portfolio, the odds of having, winners inside that portfolio are much bigger. So when you apply that portfolio theory, you have higher impact, you have diversification because you're investing in a lot of startups. So your risk go lower. So those things are happening, but the question that it brings is that, are angel investors transforming themselves into VCs? So the way for angel investing to professionalize is to transform all the angels into LPs and having some angels as GPs managing those funds. So that's a question that we can ask. But the thing is, we see now two different models regarding group investing. We see the agent model. That's the standard VC model. This means that the investors are putting money in an agent and delegating into that agent the decision process of deciding the startups to invest in, and the mentoring of the startups, the monitoring of the portfolio, and the exits. So it means that those investors are putting money there and waiting for the agent to do the work, and then I will receive reports and the outcomes. And that's it. So the agent is connected with the entrepreneurs, with the startups, and is connected with the investors. But there is no connection between the investors and the entrepreneurs or the startups. The connector model is when the agent is not an agent anymore, but is a facilitator. That facilitator is there to help the angels come together to select the startups, but then the angels will take the final decision in the startups to invest in. And then the angels will be the ones mentoring the startups and will be the ones making it happen. So they are not delegating in a manager that work of investing in startups. So this model is not anymore solo angel, of course, because the angels are investing together, and is not syndication anymore because everybody's within within the same group for an entire portfolio, sharing a common portfolio. So this model is now called angel funds. So angel funds means that it is a fund structure. It means that everybody is exposed to the same portfolio, but is an angel fund because being an angel means that the angels are there in the decision process and are there in the mentoring of the startups and driving the exits and all that stuff. So we have a facilitator instead of an agent. That's the difference between an angel fund or a VC fund. Of course, we have a lot of gray area here, and we have some VC funds that also promote the connection between the investors and the entrepreneurs, and we can have so-called angel funds that are not doing that so much. So it is not, black and white. It is a gray area. But for us to understand, there are those two models if we want to invest with portfolio theory. And now calling Cynthia to join us and to bring more data to the discussion.
Okay, thank you, Pedro. Hello, everybody. So when we're talking about returns, so the IRRs for different types of investments, we can see in this chart, this was collected from several different studies, and it compares the returns on individual angels, crowdfunding, angel groups, VCs, private equity, and angel portfolio. So we can see that the returns are higher when you have an angel portfolio approach. When you compare individual angels to angel groups, you already have a jump. So it means that investing together is already bringing more returns, and then an extra jump into the returns when you have the angel portfolio strategy approach. It's important to remark also this kind of data is very difficult to retrieve because we have very few data about angel investing. It's a very recent activity, and also because we have this, the majority of those researchers are coming from US and Europe of specific markets. But in the end, after all, we have some information about the returns obtained by each of these ways of investing in startups. Okay, Pedro, please. But then we can, if we take a look at those returns, so this first chart, this is a study that was published in 2009. It's called Siding with Angels. And it has researched 158 angels who have invested in more than 1,000 startups and obtained more than 400 exits. So if you take a look at the return distribution, so these returns, they are distributed differently across the different exit multiples scales. So when you take a look at this chart, it's easy to see that this is a game where the higher chances is of you losing money. Okay, so if you're evaluating one single startup and you're investing in this startup, the higher chances is that you're not going to make money of that. So this chart summarizes. So the first bar here is the amount of exits, the percentage of exits who have returned less than the amount invested. And this is 56%, okay? More than half of the investments. Then you have 35% in 1 to 5 multiple times the multiple, 3% from 5 times to 10 times, 5% and 1%. Okay, when you take a look at these numbers, it's quite easy to justify the portfolio approach. Okay, why are you going to invest in only 1 or 2 startups? And if you're solo angel, your money in the beginning at least will be you will be capable of investing in 1, 2, 3 startups, but not building a portfolio of 20, at least in the beginning. But if you can have the portfolio approach and you can get together with other investors, you are able to diversify this risk and diversify the portfolio and reduce the risk. Okay. And then the second chart, the chart in the right, you can see that it's a very the results are really concentrated. So 80% of the return obtained by these angels are coming from 9% of the exits. Precisely because you have many exits that are going nowhere, or that are going to return very little money. And then you have the very focused, very concentrated, very little amount of exits that will bring you the higher returns. Okay. Next one, please. Good. But then there is another thing that really speaks for the involvement of angels with startups. That is, there is a difference between active involvement and passive involvement. One more, Pedro, please. And what is passive and active involvement? So this study also evaluated what are the differences between groups of angels who are really involved with the founders, with the startups in an active way. So like being a board member, or having close interactions with the startup, weekly, monthly interactions, or even daily sometimes in specific timings. Or if they have a passive interaction. And a passive involvement is they don't have a board seat, and they also are not frequently in contact with the startups. So when you take a look at these two kinds of involvement, you can see that it reflects in the returns obtained. So the bars in yellow, they represent the exits that were done with startups that received a very high level of involvement and active involvement from the angels. And you can see that the curve is less skewed. So you continue to have 40% of the startups in the yellow bars with less than 1 time of return, but you have 16% with from 10 to 30 times the return of the exit. And this is 5 times more than what you have with the passive involvement. So if you examine this, this column of 10 to 30 times, you can see that when you are actively involvement, you have much higher chances of having this kind of exit. And the same thing for the multiples higher than 30. So you can see that the ones who are really making the best returns are the ones when you can observe active involvement from the angel side. And what kinds of involvement are those? So these involvements, they can be of several types. They can be being a board member, and so getting in touch frequently with the founders and the reality of the startup, but also helping them introducing clients or partners, sometimes some level of operational involvement. So a startup is facing a challenge, a specific challenge, where that angel has that specific background and can help them on it. So this kind of involvement is also observed. So this was, and coaching and advisory as well, this was the main observed ways of involvement in this study that I'm bringing, these 2 studies I'm bringing here. Good, so then let's take a look at this. We are talking about involvement, and that's what we've just seen in the last slide. So, and in angel involvement, we are talking not only about the angels and the relationship with the founders, and the startups, but also with other angels and with the entrepreneurial ecosystem. So this is what it goes for involvement. And in terms of outcome, this is just the other slide that I showed, but it's ordered now, the returns that we can see. So taking into account those 2 dimensions, we can position angel funds as a best way to congregate those 2. So if you take a look at crowdfunding, equity, and VC funds, they are the ones with less involvement, not only with the startups, as I said before, but also among the partners, okay? So if you are, when you have an angel fund, you're not only learning from the founders, but also from your colleagues, your angel colleagues who are participating in the decisions, who are discussing the business of the startups invested, etc. When you go to the angel syndicate, when you're a solo angel, you can have a lot of involvement with that particular startup or that particular startups that you are investing. But the chances of great financial outcome are much lower. And so angel fund is what we see as a good way of mixing those both dimensions successfully. So bringing back that concept of angel perceived investment value that Pedro mentioned in the beginning of this presentation, we can see here in the axis those dimensions that he brought to us. So the economic dimension being convenient, the emotional dimension, the self-esteem, the altruistic, the entrepreneurial. And we are here just analyzing how these different models perform in these dimensions. So if you take a look, let's take a look at solo angel and VC funds. So the red curve and the gray one, okay, they are just the opposite, one from the other. So VCs, they can get good economic results, very convenient, but all the other dimensions related to emotional links, team, entrepreneurial, they are less attended in the VC funds. In the other hand, if you take a look at the solo angel, you can have this all, but the chances of good the economic returns are much lower, are the lowest, and the convenience for sure is the lowest of all because you have to do it all by yourself. Okay, looking for the startups, contracting, deal terms, etc., and it takes a lot of work to do that. When you take a look at syndicate, so syndicate is a model that could solve some of the issues of being a solo angel because you are, it brings you much more convenience because you can have access to deal flow, you can be in contact in many events and talking to many other people. It also brings much better results than the solo angel option. And it brings also all the part of emotional, esteem, altruistic, and entrepreneurial much better than the solo angel journey, okay? But it is still lags in some points. When we see crowdfunding tries to, it's in the middle for all of them. So it's not, you are not exposed to the founders or to the startup life. You are not making a lot of money or good money. And, you know, it's too crowded, it's too diluted. So you don't have, it's middle, okay? It's in the middle of the way. And when you analyze the angel fund, what the angel funds tries to do is to bring the structure, the convenience of the funds, of the VC funds, but with the level of involvement, entrepreneurial dimension, and with much better results. So bringing the economic results as well. So summarizing what we brought here together, this webinar, the top reasons that we might say about joining an angel fund is if you are able to get high returns than the alternatives, as we've seen before. You have a managed risk environment. What do I mean by that? You are trying to reduce your risk of investment in different with different tools with different approaches. So you are investing in a portfolio. This will reduce your risk for sure. You are investing with other people. So this will reduce your risk because this will get other angles and other points of view when deciding about an investment. And it will also reduce the risk of the investment because during the portfolio management, during the life of that portfolio, you can count on other people rather than just you to help that startup. Okay, so you have a diversified profile of investors. So also, it guarantees the opportunities for involvement, learning, sharing, and contributing, and having fun. It's much more fun when you're investing with other people and learning from them and discussing things with them and disagreeing and agreeing and arguing. It's much more fun and you learn much more rather than when you're doing this alone, okay? So The other thing is, as I said, you can improve the potential contribution to investor startups. So one of the things that we see is that startups, they will need different types of support along the journey. Maybe in the beginning, they are really need help with the commercial side, but then once they started, when they have the product market fit, and they're going to another stage where they are getting traction, maybe they will have more grown-up problems. So they will demand a different kind of support. And if you're alone investing in a startup, there will come a time that will say, well, I can do much more for them at the stage that they are right now. And if you have a group and if you have people with different backgrounds, you can always talk to your colleagues and say, come on, these people need help on this and that. Who can help? Also, rely on professional leadership that helps overcome the challenges of deal flow contracting. So all that work about finding the deals, negotiating, contracting, and all this boring part of the thing, you can rely on leaders, professional leaders, to do that for you. And another thing that I find it very interesting is that you were able to build partnerships for deal flow, next rounds, and exits in a much easier way because you were a group, you were a fund, you were a group of people together. So you will be able to be exposed to rounds that probably alone, not only because of the ticket size, but also because of the partnerships with co-investors, with other groups of angels, or with VCs that are operating in the early stage, or whatever, you will be exposed to some opportunities that probably alone you were not going to be. And then we're bringing here, this is a video, is a rap battle, okay, between an angel investor and a venture capitalist. This is brought by Marcia, I forgot her surname, Pedro, sorry. She's the president of ACA. Sherwood, yeah.
Sherwood, yeah.
Yeah, she's the president of ACA, Angel Capital Association. And this is a very funny video, but it tells lots of truths about this rap battle. And by the way, she's a venture capitalist and she's an angel investor. She can talk about both from her perspective and from her reality.
Angel investor versus venture capitalist. Let the rap battle begin.
I'm here to tell you, hon, about my funds and their gains. I got so many investments, I'm just making it rain. My LPs, they love me. I'm on fund number 10. That's more than your group will ever have in AUM. The startups line up, itching to see who gets to pitch. Graphs with hockey sticks showing how we're all getting rich. We pick the best, it's a quest, and it's really quite fun. Our dollars are smart, it's an art. Your money's just dumb.
That's not nice, very mean. You seem quite cold-hearted. We are angels, we rise up. We will not be outsmarted. We are mentors, advisors, networking gurus. You put money in, I'm not sure what else you do. By the way, our checks come from our own accounts. You use other people's money. We're the ones with all the clout. We provide capital to companies at the earliest stages. We are simple, compromising. Your term sheets are pages and pages. We create structure and trust and build up the culture. You're predatory investors. That's why your capital is called vulture.
Angels, you're so cute, and your checks, they're so small. You make decisions by seeing what sticks to the wall. You think you provide value and rise up the best, but we had to step in. You created a mess. How many of them are you? The cap table keeps growing. How could this happen without you even knowing? We bought you out now. We no longer need your approval. Now step aside while we build the next Google.
Oh, right, big tech. That is your history. What's the matter? Are angel worlds a little too risky? We provide vision and value. Founders think we're heaven sent. You know your companies? We funded them first, over 90%. We are mighty in numbers. We don't need you to save us. We're the baddest, the boldest, and literally the bravest. I'm an angel. You're the devil. You just think you're the hottest, but you're nothing without me. I'm an absolute goddess.
Thank you, Pedro. Really enjoyed the video. Thanks for sharing it. Do we have any last question from anyone? Last words from Pedro and Cynthia.
Thank you, Fabio.
Just saying that if anyone is wants to start as an angel, you don't need to learn by your own mistakes. You can learn with others and start investing in the right ones together with others. So that's it.
Thank you, Pedro.
Just want to say
Thanks,
thank you.
everyone. Please,
Thank you,
Cynthia, go on.
No, I just want to say thank you and see you in the next session.
Perfect. We will send a recording of the
Thank you.
session to you all, and the presentation as well, and the link to the video. Thanks again. Good to see you all again. Bye.
Bye-bye. Thank you.
Okay, hi.
Bye-bye.
All the best from Berlin. Bye.
Bye, Tobias. Ciao.